Hello everybody, welcome to today's episode, and today I'm going to be teaching you about trading indices. Now, indices is one of many components and one of many different things that you can trade. There are many different indices, so bear that in mind. In future videos I will be covering different indices, and we'll go from there, but we're just going to start talking about indices. Basically, I'm going to give you a little a basic rundown of what indices are. So if that sounds good, please like the video, share it and subscribe. Okay, so let's start off with what indices are. So indices are known as an average for an amount of stocks present in a said index. So for example, if an index consists of, let's use the S&P 500 for example. If the S&P consists of 500 stocks, and there are 500 of them, they're weighted. So basically, if there are 500 and 250 are high weight, let's just say, I'll get into this more. I mean, obviously less than 250 are high weight, but let's just say 250 are, then that means these have more of influence. So basically, if everything is, well, I'm going to simplify it as much as I can to make it great for beginners. So if everything is equally weighted and there's 100 things in the index, 50 things are doing great and 50 things are doing terribly, the index average will be somewhere in between those. So I'm sure you kind of get that one. Pretty simple to understand. So of course, in the S&P 500, stocks are weighted upon market capitalization. This means that if a stock has more market share, it will be higher up on the index, and most indices are weighted in some way or another. So what does this mean? It means that stocks are called constituents. So you can see this one a lot. If a stock is on an index, it will be called a constituent of that index. So yeah, there are many characteristics of indexes, directly and indirectly, like I said. So general characteristics of them are weighted indexes. These are a different type of index, but these are quite common. Most indexes are weighted in some way or another. Yeah, weighted indexes are influenced by companies more high up on the leaderboard, let's say. So basically, the top companies on this index with more market share will have a higher influence on what the index does. So depending on how many constituents of the index there is, the index will be prioritized by high stocks. So basically, if there's 500 stocks and if there's 30 stocks only, then you can see there will be a greater influence by more companies on the one with 500 than there will be on the one with 30, because there's only 30 to begin with. So you can see how that one might work. So an example of this would be the FTSE 100 tracks 100 companies, of course, and stocks. So it gives a more broad perspective on the market and, things like that. So if the FTSE 100 consists of 100 shares and the Dow Jones consists of only 30, the FTSE 100 will be weighted more by stocks at the top. And also, it is going to give you a more broad view of the market. So, for example, an index consisting of 500 like the S&P will give a great indication on the general American market, whereas the Dow Jones, only consisting of 30, may not give such a clear indication, but that is a topic for another video completely. So indirect consequences from indexes are what can happen to stock. So like I said, if you are trading the FTSE 200 and 50, and then you start to look at the FTSE 100, and you see a company which pops from 101 on the leaderboard to only 100, that will make it a constituent of the FTSE 100 index. Now, when a company is a constituent of an index, this will generally release higher brand awareness and stuff like that amongst investors. So this will make it, basically, the stock value will increase over time. This has been proven before. I'll talk more about this in the FTSE 100 video that I'm going to be making tomorrow. So yeah, the FTSE 100 or other indexes, once a stock gets on an index, it will be generally more recognized. So that's one thing to consider if you want to invest in an individual stock. But if you want to invest in a whole index, then that's not really too related. But yeah, the companies on an index can change. So a company can get knocked off the index, a company can come on the index. So that's something to remember. Okay, so how can we actually trade indexes? So there are many strategies that we can do this, and many ways that we can do this. So we can do things like inter-market analysis for lots of different countries. So for example, with what's going on right now with the coronavirus, we can see many indices are actually rising and many are falling. So this will show the world economy. So, for instance, the American ones tended to rise, so that shows that America's doing well. Other countries are falling, showing that, the coronavirus is having less or more of an effect on these countries. But then we can compare all the markets and see, look, let's have a look generally at what the whole world economy is doing. Anyway, sometimes there are pairs which you can trade. So an example of this would be the FTSE 100 and the UK Great British Pound Forex currency. So generally, when one of these goes up, the other one goes down. So the FTSE 100 is up and the Great British Pound is down. Now, I'll explain this one, like I said, in the FTSE 100 video, but you know, that is something that tends to happen quite a bit. So there are some other pairs that you can trade. Of course, look into that if you are willing to, and I intend to cover this far in the future because we are just going to go over some basic indexes that I think that you need to know in the future. So yeah, we'll cover this quite a way down the path in the future. So how can you actually trade indexes? There are many different ways. You can't actually trade an index itself, because, you know, how are you going to trade a group of companies, you know? But there are ways that you can do this actually, but not directly through the index, if you understand where I'm coming from with that one. So we can use things like index funds that basically mirrors the behavior of the index. So you can basically invest in all of the companies as a fractional share for, you know, a smaller price and invest in each one share. So, you know, you can own a tiny amount of the companies for a small amount of the price in an index fund. And there are also things like CFDs and spread bets and ETFs that you can trade. These are similar things. They mirror or show what's happening in the market and basically copy that, and you know, you can trade those as well. So next episode, like I said, talking about the FTSE 100. So please do stay with us for that one. But do note, trading stocks and CFDs and ETFs and basically all type of trades is very risky, and please risk at your own, you know, at your own will, because it can be quite risky. But if you know what you're doing, you can minimize that risk slightly. So bear that one in mind. See you in the next episode. Goodbye.